Hello and welcome to Inside ETFs. I'm Ramzan Karmali. Today we're looking at buffer ETFs and my guest is Matt Kaufman, Head of ETFs at Calamos Investments. Buffer or defined outcome ETFs use derivatives to limit the impact of bear and bull market extremes by offering investors the chance to swap some upside performance for downside protection. That was particularly useful during the recent spike in stock market volatility. In fact, Innovator Capital Management, which launched the first type of these funds 6 years ago, said that its inflows were probably 5 or 6 times what they would see in a typical week. But the rise in their popularity goes back even further. Over the last 3 years, assets invested in these products have soared to $41 billion or more, from less than $10 billion. But some analysts have warned that by investing in these funds, you could miss out on potentially much greater returns. Well, to help us look in more detail at buffer ETFs, I'm joined by Matt Kaufman from Calamos Investments. Matt, thanks so much for joining us. Well, there are a number of buffer ETFs out there, and some actually offer up to 100% downside protection. Can you just tell us how that actually works?
Yeah, that's right. There are a number of buffer ETFs out there. A lot of them are issued in monthly increments. And so that's why there are a lot of ETFs in that space out there. The number can grow rapidly. But if you look across the actual strategies, it's probably more like 20 to 25 strategies. So if we just take this 100% protection idea, we can replicate that. You know, if we just pretend like I gave you $100, we can replicate that downside protection. So we're going to spend about $98 on a deep in the money call or a near zero strike call. That's going to be our participation layer. It's going to replicate the exposure of the underlying asset, like the S&P 500, the NASDAQ 100, or the Russell 2000. The next layer is the capital protection layer. That's going to be buying an at-the-money put, and that's going to cost around $4. So, you know, if you've been following along, we've spent $98 on your participation, $4 on your protection. So we spent $102. So we're going to have to sell off some upside in order to bring that back in line with $100. So we sell off enough upside. You know, there's no free lunch here. We sell off enough in order to collectively have that $100 package. And then you can get the upside experience relative to the S&P 500 with no downside protection over, in this case, a 1-year outcome period. That's the expiration date of all three of those options legs.
And during this recent period of volatility that we've just had, how did these ETFs perform? Were they able to protect investors?
Yeah, the ETFs performed exactly how we expected them to, which was very, very good. The protection level held up. That at-the-money put that we owned was protecting investors all along the way. You know, Calamos has 5 ETFs in the market, all offering 100% protection over that outcome period. So just pick an example. Our August series, CPSA, was down 41 basis points over that 5-day correction period that we saw, while the S&P 500 was down about 6%.
But Matt, if we look at the biggest buffer ETF that's out there, the FT-Vest laddered ETF, BUFR, on the face of it, looks like it's performed pretty well this year. It's up around 8%. But that's still lagging behind the S&P and the NASDAQ. So that's criticism that analysts have, that perhaps you're not getting the best for your buck by investing in buffer ETFs. That's true, isn't it?
Well, I think the beauty of these types of products, the buffer ETFs or the 100% protection ETFs, is that you can know your upside opportunity, you know, how much upside you have, how much downside protection you have, and how many days you have to hold in order to obtain that. And so you can know that profile before you invest. You know, the ETF that you mentioned specifically is called a laddered product, and that blends a number of buffer ETFs together in a single ticker. So there's several firms that offer that, and Calamos has a laddered version of the 100% protection coming out in September as well. And so that gives you that blended exposure. But again, one thing that people are really finding value in is the opportunity to know their upside and their downside before they actually invest their money.
Now, what about fees? Because if the fees tend to be higher on buffer ETFs compared to, say, a pretty standard vanilla ETF, do you think that's justifiable?
Yeah, absolutely. I mean, these are not standard vanilla ETFs. These are active ETFs. They're all very sophisticated options strategies. You could not replicate these types of option strategies on your own. You have to go through the ETF vehicle in order to obtain the tax efficiency that we can provide in the ETF wrapper. But then if you look outside the ETF wrapper and other products like structured products and certain fixed index annuities, those products are often a lot more expensive than what you might pay for a structured protection ETF or a defined outcome ETF.
Now, you mentioned the ETFs that you've launched this year. What makes them stand out from the other buffer ETFs that are out there at the moment?
Sure. So we launched the first series of 1 year principal protected or 100% downside protection ETFs on the S&P 500, on the NASDAQ 100, and on the Russell 2000. So it's the broadest suite available. Calamos has been in the risk management game for nearly 50 years, and this is another innovative tool that we're offering our investors.
Matt Kaufman from Calamos Investments, many thanks for your thoughts. And that was your look at buffer ETFs. I'm Ramzan Karmali, and this is Reuters.